Good morning to all of you being here and to all of you listening in to this Alimak Group's fourth quarter and full year 2016 presentation, and also an investor update at the end here. I expect this presentation to take roughly about 1 hour, and after that we will open up for questions that I also expect us to be able to answer. And by that I suggest that we just move on to the first page in the presentation, or page 2 that is in the presentation, starting with a quick view on the full year 2016. I think it's fair to say that Alimak had a strong finish of what I also considered being a challenging year. There was a lot of events and happenings in the global economy. Despite of that, I think we made a year where we delivered well. And starting with the construction, I think again construction industries in Alimak delivered just another strong year, strong growth in all the regions of the world during 2016. After sales increased their penetration in construction industry, maintained a strong margin throughout the year, and ended up on fourth quarter with a significant improvement over last year's EBIT margin. Rental as well developed well throughout the year, high level of utilization through the year, while industrial equipment still being sort of impacted from the lower demand that we continue to see in oil and gas and in the mining industries. On top of the business results in quarter 4, we also signed 2 acquisitions, Facade Access in the very end of October, and then Avanti Wind Systems in very beginning of December. So all in all, these 2 acquisitions doubled the size of the company, and I would say delivering on most of the financial targets, making the group doubling the size. I think I would just like to give or take this opportunity also to give a big hand to my management team and all the employees that have achieved these results in 2016. Moving then to next page and see how this summary translates into the numbers. Order increase up 2%, so 2% growth on orders, taking the order level up to well about 2.1 billion Swedish crowns. Revenues increased to slightly above 2 billion Swedish crowns, an increase of 1%, while the operating profit or the adjusted EBIT ended up at 330 million. And here we had an impact from the lower revenues coming out of the industrial side. Still, I would say a good number, where the EBIT margin ended up for the full year at 16.1%. So all in all, numbers that I am still proud of being able to deliver, and I know that my team and employees are also well satisfied with these numbers. Moving on to next page, and I think page number 4. I think this one clearly demonstrates the resilience of Alimak. We have seen headwind in industrial for quite some time, and despite of that, we see other business areas coming up and deliver either on or above the targets, making the group still being able to grow and deliver on the targets that we have set for the group. So, the growth that we have seen in construction, well compensating for the downturn that we have seen in the industrial side, at least on the top line. I think this is really demonstrating or showing the strength of Alimak Group. And of course, given the situation that we have had during 2016, this is also changing the distribution, what each one of the business areas is contributing in, both in terms of revenues as well as in EBIT. But still, important to know is that there is always someone who is overperforming and compensate when the cycles are getting tough for one or the other business area. If you look at quarter 4 of 2016 and a quick summary on that quarter, strong order intake, 22% up, very much driven by construction side. Construction alone had 49%. So I think the pace that these guys are developing the business with is it's just great to see. Revenues up 2%. Also here, construction large driver for the growth that we saw. I should also mention that revenue-wise, it's actually the best quarter we had since we listed. So it was really a strong finish. EBIT margin ended up at 17.5% for the quarter. So I would say also result-wise, strong quarter. And I'm also very pleased to see the improvement that we saw in the EBIT margin on after sales, reaching up to 34.2% for the quarter. So all in all, I would say there was really a strong finish of the year. Moving to the next page, taking a deeper dive into the different BAs, starting with the construction equipment for the quarter. As I said, an order intake growth of 49%. Construction saw growth in all regions. So all in all, it was a very good quarter. Market conditions are still out there, so I really see construction being on a very good path. Also on the revenue side, again, good growth. And of course, the increase in EBIT coming out of construction, what it adds to the group, very strong achievement overall from construction in quarter 4. Moving to the next page, page number 7 takes us into industrial equipment. Order intake down 2% versus fourth quarter of 2015. Having said that, I think it's also important to remember that if you compare quarter 4 with quarter 3, we nearly doubled the order intake. So I would say there are still some good lights out in the market, and I think we clearly also demonstrated that in quarter 4 on the order side. Margin-wise, impacted by the lower revenues coming from the lower orders that we see in previous quarters, also at the end of 2015. Oil and gas and mining industries, as I already said, remained weak. So result-wise, the lower revenues have, of course, also translated into the lower margins on the industrial side for the EBIT. All in all, my takeaway from this is still that orders showing good improvement versus Q3. So I think there is still a good development in the market also on the industrial side. Moving down to the next page, page number 8 takes us into rental. Strong order intake on Q4. I should probably also say that the comparison is a fairly easy comparison because Q4 on orders in 2015 was not too strong. Still a good number on orders. Revenue down 14%. To me, that is seasonalities. In between projects, one project ends, another one starts. There is time between the projects. So for me, this is just timing. Good backlog is there. Order was good. So this is really seasonal. However, the lower revenues also translated into slightly lower margin. So We ended up at 13%, still solid improvement over last year. So all in all, also for the rental business, I'm very pleased to see the development that business has been through in 2016. Moving down on to the next page, page number 9, after sales. Stable order intake, up 2%, revenues up 5%. Again, improved EBIT margin for the quarter, ending up at 34.2%. Very strong quarter, very much driven by, good mix, i.e., the mix between parts and hours is, favorable. And of course, people being busy drives the utilization rate up. So all in all, I would say also here, a strong, very strong quarter also from after sales. EBIT up 12% versus Q4 2015. So yeah, I would say good solid quarter also from after sales. Just to repeat again, really showing the resilience of the group also for the quarter. But as you can see, nice to see construction equipment, taking a fairly large share of not only the revenue side, but also a solid share of the earnings side, which is, good, solid statement coming out from the construction business. Very happy to see development that is taking place now. Then I think if we move to next page, then Ekstedt, our CFO, he will make his first quarterly presentation of the group financials. So I guess I leave the stage to you, Per. So please.
Thank you, Tormod. Getting a quick dive into the numbers, starting off with rolling 4 quarters order intake and revenue. As Tormod already mentioned, we have an order intake which year on year has a growth rate of 2%. Since 2013, on a rolling 4 quarter, it has never been higher. Going back to the revenue, it's alone 597 million for the quarter of 4 of 2016. The 597 is the highest since 2013. And actually, the Q4 used to stand for like 29 to 30% of the yearly revenue. So we see steady growth, and even though we have had a decline within the industrial segment, we still have been able to increase our revenue with 1% since last year. Getting into the EBIT adjusted numbers, we're coming from a level of 17.2. And we have, even though we have a shortfall within industry, been able to deliver 16.1% in EBITDA margin. And the difference is 20 million between 2015 and 2016, but still being on a level of 330 million. Getting into cash flow, we have a strong financial position. Our cash was 450 by the end of 2015. By the end of 2016, we ended up at 231. We have a cash flow from operating activities, which were on a level of 224 compared to 240 the full year of 2015. The net debt has decreased from 375 million to 295, and we've been able to also lower the leverage to 0.8 compared to 1.1, and as you know, our goal is to be around 2. If we look at the earning per share, just for Q4, we have last year 1.66 kroner per share. This year we had an earning of 1.12. For the full year, we have an earning this year of 4.48 compared to 3.12 for the full year of last year. Dividend proposal. Well, the board will, to the annual shareholders meeting, propose that the dividend in millions should remain the same, approximately 86 million, which corresponds to 2 kroner a share with the existing number of shares. Thank you.
Thank you, Per. Then I think we have arrived at the investor update, and this is not a presentation of the new group because we will not present too many products and applications in this presentation. It is more a presentation of what does this acquisition or these acquisitions mean to Alimak going forward, and then at the end of the presentation also end up going through and present the new financial targets for the group. Just starting with the pillars. So if you move to page number 18, these are showing the pillars that we presented as the real pillars for the investors to look at and to look into Alimak at when we went to the IPO. And to us, these pillars are today the same. We have said in I think 6 previous quarterly presentations that we have a set of items that we look at when we are chasing potential M&A targets. After sales is one of them. We would like to expand our portfolio into vertical access solutions, and I think we have demonstrated with these 2 acquisitions that this is also what we've been doing. And I will take you through a presentation also showing where these acquisitions lines in also with our pillars for the investor case. Starting then with global market positions, and Alimak was already a global leader. The 2 companies that we have acquired, namely Avanti Wind Systems and Facade Groups or group with the brands CoxGomyl and Manntech, those 2 are both leaders, global leaders in their niches. So what we have acquired is 2 companies that adds to the brand recognition that we already had in Alimak. We acquired 2 further strong brands that we see is still carrying a strong, good potential to further develop within a number of areas. Avanti you would have seen most probably because a vast number of windmill towers across the world has Avanti service lifts installed in the towers. So they are widely spread both in Europe and actually on all continents. So also here a solid distribution of the products. Looking at facade access and the brands coming out of CoxGomyl and Manntech, they are not so easy to see because they would normally either be built into the buildings or they will be sitting on a rooftop on the scrapers around the world. This is an overview. This is showing 12 of the world's tallest and most complex structures, so buildings. These are all equipped with solutions either from CoxGomyl or from Manntech. You would need to extend this one with 2 more and taking up to the 14 tallest before you would see even a competitor name on that list. So it's quite impressive. We have the tallest one, Burj Khalifa. Myself had the pleasure to be there. And we're not talking just one, building maintenance unit that sits on this one. I think on Burj Khalifa, I think that one has 22 sitting around, and it's all built into the building. So the facade opens like a garage, and these machines comes out, and I can trust me, these are big machines. So it's a fascinating application. Sorry, I get excited by that. I think it's fantastic. So. As I said, vast majority of the building, the tallest structures in the world are actually equipped with our equipment. Strong competitive positions. I've already touched upon the brands, the product portfolio. I think we have a unique customer reference list as well. The track record that all these companies, Avanti, Facade Access, and Alimak, the track record that we have within safety, quality, reliability of the products, it's a very, very strong track record. Install base of more than 66,000 units creates a solid platform for developing the after sales going forward. These units, these solutions, vast majority again are customer, customer made. They are made to fit for special purposes. So I think it also represents good opportunity, solid opportunity for after sales, but also the fact that we have people, engineering people who can provide solutions for it, makes Alimak a powerhouse within vertical access solutions. And add to that unique, both global as well as a local support and service facility to serve the customer's needs. Nobody is equipped like that in our industry. Vision, the same, multiple brands. We're sharing the same vision, a global market leader within vertical access solution, delivering solutions both to the industrial as well as the construction customers. There is no change in that. If anything, I think we should aim for getting even stronger in certain markets. But overall, I think this is a good, strong vision to continue to deliver on. Attractive business model with resilient aftermarket revenues. Many of you would recognize that one. We are serving a lot of end users, as I said. I mean, we're serving the industrial market with all the different verticals. We're serving construction customers. We are now adding both products and technology as a platform to further, bring out even new products to strengthen our positions in these markets, serving different needs popping out from these markets. So all in all, I think we are broadening both our technology platform as well as our product platform going forward. Aftermarket, we know that what this can represent. We've seen that demonstrated quarter after quarter, year after year within Alimak. I think it's a very strong story. We know roughly what it means when we are selling a product on the industrial side, and what that also represents in future revenue stream. New companies that we have acquired is not in that same position today. But of course, we are looking into the opportunities, the potential of course, applying the same business model also to these newly acquired companies. I'm pretty sure that when we start to think of what after sales should mean going forward, and we can start to design that in already during the R&D stage of a product, we will see some of the same development coming through also for these newly acquired companies. You also see on this one what after sales makes up of the group revenues. That is also for these newly acquired companies, not quite the same, but it is also telling a lot about the potential that should lie ahead of us. So all in all, I see a set of strong, solid opportunities going forward. Moving to next page number 26, that is. Business supported by the four business areas. We have not changed our setup in terms of the way we are running our business. We are still organized within industrial equipment, construction equipment, rental and after sales. Two newly acquired companies, Avanti and Facade Access, are being positioned within industrial equipment, and that will also bring the revenue based on a 2016 pro forma. It will bring the share of industrial equipment up to 49%, for the group. So with these two acquisitions, we are certainly expanding the size of the industrial side. That leaves 17% in construction, 8% in rental, and 26% in after sales of the group's total business. So the two business areas that are impacted directly from this is really on the industrial equipment side as well as on the after sales side. Moving down to next page number 27. Strong international platform in emerging and in mature markets. Most of you would know how happy I am with the page that we are showing on page number 28. It's really showing our global footprint. And of course, with these two acquisitions, we are further expanding our footprint. We used to be 2 production facilities within the group. With these 2 acquisitions, we are adding 10 more. Also, I would say these 2, in particular Avanti, having a very distributed footprint. They're having footprint in the Americas, they have footprint in Asia, in China, and they have a strong footprint in Europe. If you look at facade access, they have mainly the footprint in Europe, but that is of course also something that we are looking at going forward. Anyway, it represents a huge set of opportunities for the group going forward, because we are strengthening our sourcing capabilities throughout the world. And of course, we are adding more salespeople on the ground that would apply also cross-selling eventually. We are increasing the number of service people that we have out in the field. And we certainly foresee, given the fact that base technology is many ways the same, people will have the ability to do service on multiple products, multiple solutions, given the experience they already are coming from. So all in all, I would say that increased number of people, increased feet on the ground is certainly increasing the number of opportunities, and topping that with an also increased number of distributors is all in all very much strengthening the position of the group when it comes to our footprint. If you move to next page, have a look at the distribution of the revenues before and after, again based on pro forma 2016. As you can see, slightly increase in Asia Pacific, same for Europe, while Americas is coming down from 34% to a 27% share of the group revenues. Business area, already been touching upon that one, so I'm not going to spend too much time on that one. It's really a big thing here is industrial equipment is going from an 18% share of the revenue up to a 49% share of the revenue. So all in all, I would say large, or a strengthening of the industrial side, but we also know what that is representing on the after sales side. So all in all, I think this should be looked upon as a good thing. Moving on to page number 31. Again, we are really an end-to-end player in our industrial space, starting from the design stage, taking it all the way through to after sales. Already been saying that we do have strong direct sales force combined with some 100+ distributors out there to serve what we are designing, producing and installing. Again, 12 production sites, both in developed and in emerging markets. And of course, a global service network that are fully able to take on and service more than 66,000 units of installed base sitting all across the world. So again, I think this is really representing a strong potential for growth. Moving on to next page, the fourth pillar in our case, page number 32, high profitability and strong cash conversion. If we look at what the group would have looked like pro forma 2016, we would have had orders sitting at some 4.2 billion Swedish crowns. We would have revenues at slightly above 4 billion, while our EBITA would be at 483 million, with an EBITA margin of 12%. So this is really our starting point, and we aim, of course, to take the company forward from here. Moving down to the next page, page number 34. Dealing with the synergies and the integration of acquisitions that we signed and one closed, one to go. Starting with the synergies, we expect synergies to be at some 2 percentage points on the EBITA margin, and we expect that to come in with full effect in 2019. Where are these synergies coming from? Well, first of all, we see clear synergies coming out of procurement, but also manufacturing optimization. When I say manufacturing optimization, it does not mean that we plan to close any factories. But we see that there is components being produced by one company that is in need in one of the other companies. And we see an opportunity of optimize this, but also do actually more insourcing in, of components already being produced by one of the two companies. And we even see that Facade Access is buying a lot of equipment, in particular on the rack and pinion side, that we are also producing in Alimak. So there are a number of opportunities to look into, and they are all representing part of the synergies. After sales, already been touching upon the opportunities that lies ahead of us. Having more people serving a larger population, we have absolutely the opportunity to cross service, independent on what arm you are coming from in the new group. Number of good, strong opportunities also there on the synergy side. And of course, we are bringing in two fairly large companies. They are also coming in with strong management, good management potentials. I think the fact that people are coming from different parts of the world, I think we are in strong need of that also going forward. So I definitely see also an opportunity to strengthen both the structure as well as the people side of the organization. So I see a lot of good opportunities really coming out of these two acquisitions. Looking at the integration side of it, we expect the transformation to be ready by 2019. Ready in the sense that it is sort of fully integrated, but there will always be further potential to develop. We have already defined 15 different work streams that are addressing the whole value chain within the companies to see, where do we or how do we integrate. And this is not a sort of a one-way road. It is not this is not a process of forcing two groups into doing exactly what we do in Alimak today. We are cautiously evaluating the best practices, trying to find out what are the two companies coming in with that we believe would work better than what we are doing on Alimak today. And if we think that is better, then we're using that. So it is not just a one-way or a forced kind of an integration. We are extremely open-minded because we steal with pride. If we believe something is good for the group, we apply that. So that is how we are driving the integration. So we have people, in these 15 work streams coming out from all three companies. And I think that is also good strength. Integration cost, we expect integration cost to end up at some 110 million Swedish crowns. And we expect the vast majority of that to come out in 2017 and in 2018. So that is more or less how we will see the timing of the cost coming through. If we move to next page number 35, positioned to capture growth both from trends as well as from own initiatives is the last pillar in our case. Then moving on to page 36. I believe that we are well positioned to capture growth from the trends that you see in the global market today. We see that urbanization or the global urbanization is continuing. More and more people are moving into the larger cities. Health, safety, and environmental regulations just coming more and more in force. If we start on the health and safety side, we see, in emerging markets, people are no longer allowed to climb heights within being, properly protected. On the environmental side, renewable is here to stay. There's been a lot of discussions about renewables lately, but we see huge investments coming out in Asia. We see it in China has a huge investment program, in wind in particular. India has a large investment program. So we believe that renewables is definitely here to stay. We see the cost picture of developing like wind is really coming down, even if you combine it with combined gas and coal. So we are really believing that the trends are in place to support our business cases going forward. And of course, on operational efficiency, labor cost is not coming down. It's not coming down in developed markets. It is not coming down in emerging markets. So the need to put in place solutions that are efficient, that are protecting people, is absolutely present also going forward. So number of trends that I strongly believe supporting our business case. And of course, we do have our own growth initiatives. Quite a few of you would have heard about these before. On the construction side, we continue to strengthen our footprint, both our own salespeople, our distributor network. We continue to deliver on new product portfolio, taking new products into the market. So that is definitely a part of it. On the industrial side, also here, we adapt to the needs that we see are present in the emerging markets. We just released new product on the industrial side for explosion-proof elevators for emerging markets, just being approved by TÜV. So we are adapting our portfolio to the needs that we see in the market. And of course, there are opportunities of cross-selling from the companies that we have acquired. I would say maybe Avanti in particular on the industrial side. They are doing service lifts that are certainly in need, also in part of industry verticals that we today are not really serving. You can take the grain industry as one, I mean, with silos. Avanti is able to deliver, extremely price competitive solutions that can serve that market. So I see good opportunities also in the industry market going forward. And of course, also the fact that we are expanding our footprint with salespeople is also adding to the opportunities. After sales, already touched upon a number of times, it's 66,000 units that are sitting out there just waiting to be served, and it should be preferably served by us. So all in all, also here, also with the added number of people, strong, good opportunities going forward. So all in all, again, I think we have a solid case, and I think we have demonstrated that we can do it. And of course, we want to do it again. So what does all this translate into in terms of financial target going forward? Given the fact that we have acquired 2 companies, we have doubled the size of the group. We have acquired 2 companies with a slightly dilutive effect on the EBIT. We have ended up with targets as following. We have ended up with target for revenue growth, and I say that. Our midterm target is to have an average annual organic revenue growth of at least 6%. EBITA margin, and we have changed from EBIT to EBITA. And why have we done that? We have done that so that we can, take out the effect of the amortizations that are related to these newly acquired companies. So it is easier for those who are following us to actually measure us. And that is why we have gone from EBIT to EBITA. And our midterm target for EBITA is to reach an operating margin of at least 15%. So those are the top line and result targets. Capital structure, net debt over EBITDA, that one is unchanged. We have a target of 2 times for that ratio. And when it comes to dividend policy, we also have unchanged target. Our aim is to distribute dividend of approximately 50% of the net profit or net income for the group. So I think all in all, these are summarizing the group's financial targets that are valid as from today. And I think by that, just showing the pillars that are summarizing our story. So the story continue. And I think by that, I would open up for questions. And we should, I think, start with the questions here. So we open up for questions. So Per and I will take questions and hopefully give you some good answers as well. Please.
Okay, Johan Hüttner with Handelsbanken. So starting off with some questions on the targets. 2 questions on growth. You specify it as an organic target. In the writing, it seems like you will be more focused on profitability than growth. So the question is really, how does M&A play into your targets going forward? And then the second one on the margin target, it's the synergies you present. I don't think that will quite take up the margin to 15%, even if you do 17% in the old business. If I have calculated this quickly, correct. So where is the rest to come from? Is it more after sales and better mix in Avanti and Facade, or is it something else? Those are my questions.
Okay, if I should start with the last one, I think if you start on the 12% where we are, adding the 2%, then we are getting to like a 14%. If you say that we have a target of at least 15, I would expect our business to continue to develop. I would expect a bigger portion of industrial to come back. So I would expect margin also to come from that to make up for the sort of missing 1% at least that you are addressing. So all in all, like a 2 percentage point from the synergies here. But of course, we have plans that goes beyond that also in all the other business areas of Alimak. So I think I would leave that as an answer to your last questions. When it comes to the growth, and if your question is whether any potential M&As would be included here, it would not. So this is all about organic. Any M&A, initiatives or results of M&A activities would be an addition.
The question was more your intention to look for M&A.
Oh.
Do you need to integrate Facade and Avanti first before you have any ambitions to acquire more companies, or would you be able to make an acquisition tomorrow if the right target shows up?
I think I should probably answer as I've done in the previous 6 quarterly presentations. We do have an M&A agenda. That is not changing with the fact that we have newly doubled the group, acquired 2 companies. But I've also stated pretty clear earlier that our main priority is to make sure that we can deliver on the value that we have said we should create with these 2 acquisitions. So that is our priority number 1. But having said that, there are other people in the group continuing to work on our M&A agenda. And as you said, if the right one, comes by and you see that as a one of the time opportunities, we would of course consider that as well. So we will run our M&A agenda as we have done it.
Okay, so no change there?
No, not really.
Okay.
Hi, it's Johan at SEB. A couple of questions. Firstly, what are the structural reasons for these acquired units not to be making the same type of margins as Alimak today?
I think really if you look into Alimak and look into where we are coming from and our strong history, in particular, I would say on after sales with very high and strong margins, then I think it has a lot to do with focus. And I think Alimak for quite some time made sure that focus was increased within after sales, and you started to prepare for the after sales stage of a product life cycle already when you do the R&D of your products, so that it is not so easy to exchange part of a system, part of a product with just commodity products. So you kit it, you design it in a way that it becomes sort of a proprietary unit or a proprietary kit that is not so easy to replace with some simple commodities. So I think a lot starts already in the design stage and the thinking of the business cycle of a product. So that is one part. Then I think if you look at, in particular, maybe on the facade side, that has seen a very strong growth. They had a growth of 28% in their last fiscal year. And remember, they have been on a deviating fiscal year, but they had a growth of 28%. They, together with their owners, they had a focus on top line. We have said, and that is also reflecting in our targets, we have said that we will probably have a stronger focus on quality of earnings rather than top line alone. So that is our focus. So I think you are very much driven of the focus that both management is having as well as the owners.
That sounds more like an issue of time and management focus rather than sort of structural. Is capital intensity significantly different?
No. It is when it comes to the need of capital, Avanti is very light, I should say. Facade access is, I would say, on nearly the same level as Alimak.
If I could just follow up on synergies, you talked about 2 percentage points margin improvement. How much of that is actually validated and planned cost synergies? And how do I parse that to the quite significant integration cost of 110? If we just assume that half of those 2% is actual cost savings, a fairly skewed relation, at least in my view.
We haven't really disclosed how much is coming from what. There is still more that is coming out of cost savings than the 50% that you are referring to. I think you're more to 70-30 coming out of the cost side of it.
Okay, just finally on growth, if you talked about FAG 10% market growth, Avanti 4%. That sort of back of the envelope, it makes you half roughly anticipated growth in sort of Alimak Classic. How will that impact sort of the management agenda in Classic Alimak? What sort of significant measures are being changed the way you run those operations?
No, I think we are continuing. We're continuing our development or continue to build on the development that we have so far seen in construction. We are, and I've said it a number of times, that we believe there is significantly more to do on the industrial side. I expect actually some of the oil and gas market to get back at some stage, although I haven't factored really too much in to that for 2016. I also mentioned a number of cross-selling opportunities that are coming in particular out from the product portfolio that Avanti is bringing to the market. So all in all, I see good opportunities. I've already touched upon a number of times, both construction as well as after sales. Adding to that, some of the markets coming back that has really been on the low side the last year and a half, namely oil and gas and mining. Adding to that, also the opportunities that are coming from the newly added companies. I think that is the sort of agenda that we are driving going forward.
Yeah.
Kenneth?
Yeah. So 2 questions then. One on the Chinese construction equipment market. There have been some good data on the sales of excavators, for example, coming out of that market. So do you see that payment terms are getting better and that market will open up for you as well?
I'm still sort of reserved when it comes to the Chinese market. Because when you refer to excavator, I think that has more to do with infrastructure rather than construction. Or at least the traditional construction that we are supporting or delivering products into. So we are still, I should say that we have probably seen a slightly improvement in China. But we are still very cautious. Because the payment issues are still there, or the lack of capital on the customer side, at least coming from the rental players, the smaller rental players in that market is still an issue. So we are extremely cautious in that market, and we do have the luxury to be so because we have such a good momentum and pace in other emerging markets coming out with our products. And we are by far the largest exporter of these hoists out of China. So we have become the big player in the main market if you look outside China. And we cannot really afford to be sitting there with a lot of account receivables that are never coming in. So we are still cautious on that market. We're having a lot of focus on the industrial side of the Chinese market because we believe there is certainly a number of opportunities, in particular in the power side coming out of that market. But I would say that what you're referring to is still not translating into the sort of construction market that we are serving. So we are still cautious. That's what I would say. But that also means that there should be at some stage a larger upside also coming from the Chinese construction market.
And then also, if we look at the oil and gas market, I remember mid last year you were saying that if there is no improvement coming from that segment and the outlook is going to remain very poor, then you might have to do something on the cost side in terms of engineering and R&D resources and so on. Now we have seen some more activity in the sector, and you also made these 2 acquisitions that might require some more engineering resources to cooperate and so on. Or are you still thinking about sort of downsizing your R&D capabilities in the traditional Alimak or
No, we given the momentum that we have seen in construction, we've been able to, or not been able to, there has been a demand of resources going into construction. So, people have shifted from industrial applications into construction applications. So been able to do that. We have made some adaptations on the front end side in certain markets where we, haven't really seen results coming through as we have expected. So we have actually done some initiatives already, but those not of a big scale so that it blows up in any way. I think we have taken some good measures in some countries, in some markets, on the cost side. I believe that going forward we will still be able to use those resources, and I also honestly believe that eventually the oil and gas market will get back. I know that if you look at Johan Castberg, I think since they have changed the concept also to adapt to the price level on oil, I think their break-even price per barrel has come down to 40. So I think some of these fields that are subject to be developed starts to become profitable. So I would be extremely surprised if we don't see fairly large development projects, in particular in the North Sea, start to be approved for development during 2017. So it's also important to try to keep on knowledge people. But of course, if we would see that it never made an improvement, then you cannot do that forever. But right now, and you also saw the increased order intake from Q3 to Q4. It's good to see. So the sort of expectations that we have had, that there is more to do on the industrial side, also in verticals that we haven't really been targeting in earlier times, also is carrying some potential. It's also see that is bearing some fruits. Then we will open for questions from the
telephone conference.
Yes.
Operator, do we have any questions?
Thank you. As a reminder to participants on the phones, please dial 01 if you have a question. Our first question comes from Klas Bergelind of Citi. Please go ahead. Your line is open.
Yes. Hi, Tormod and Per. It's Klas from Citi. I've got 3 questions, please. Firstly, on the margin, you say that it's 12% EBITA pro forma 16. What is the EBIT margin? I.e., how much is PPA? And the reason why I'm asking this is that it appears as if you consolidate or will consolidate Facade and Avanti at lower margins than I thought, which would signal a weak end to the year for Avanti and Facade versus your own trading, which was stronger.
Should I answer that one? Well, the difference between the EBIT and EBITA in the Alimak group is only 1 million in 2016, and both Facade Access and Avanti fairly came into our expectations. So there are no major differences from what we previously said.
Okay, but what is the if I ask you like this instead. So we have 2 very asset-light businesses. We have 2 big backlogs, which will be, or at least for Facade, which should be extra scrutinized for amortization if we think about future value of customer contracts, which might require continuous amortization. So PPA to sales here could be quite big. So let's try to understand, when you guide your EBITA margin of 15%, what is PPA to sales of the acquired units?
We need to get back to that if I'm not able to answer that question right now.
Okay, but there was no underlying sort of weakness to the margin back end for Avanti and Facade in 16.
I think, Klas, I actually think that if you remember the presentation we made when we acquired Facade Access, we had an EBIT margin at that time slightly above 7%. While when you look at the pro forma page that we showed here, we had an EBITA margin that was 6.2%. And I think we have no worries about that. This was Facade Access half year. They are running a system business. We have looked into, we have had business updates with Facade Access since we signed the sales and purchase agreement, and I feel comfortable with the margin level that we look at going forward. But it is slightly probably different of that 1% that you would maybe have put in your calculation from when we presented the acquisition.
All right. The second one is on industrial. Orders are obviously bouncing back nicely from a low level. But how much of this is new business in the mid-market versus previous order delays abating? We know that customers were hesitant to place orders in the past given the discretionary nature of your business. And also last quarter there were absolutely 0 orders in oil and gas. Did we pick up a little bit in oil and gas from that level.
Yeah, we actually had some contribution also from oil and gas in the last quarter, and I'm actually quite happy with what we saw, also in terms of new customers, new applications. It's starting to gain traction. The fact that people know that we have to go out and collect orders from other places than just where we used to collect them. So I think the quarters demonstrated some good movements in that, and as I said, it was of course disappointment to be lower than Q4 2015, but as you said already, if you compare that to quarter 3 2016, was a significant uptick on the order side, and was good, and there's some good lights in there, absolutely.
But just to come back to, because over the last 2 to 3 quarters, if I remember correctly, we had customers basically saying that no, we are going to wait to place orders because we don't need the hoist and the lifts right now. So did you see sort of a change in tone in terms of customer behavior, that they are now starting to place orders, those that were hesitant before? I'm talking outside of oil and gas.
Yeah, I believe there is a slightly more positivism. I think there were some, we already talked about that earlier, and I think there was some hesitance after the Brexit. So immediately after that, we certainly were on the receiving end of people, really thinking twice and reconsidering what they sort of already had made up. Then I think it also had some uncertainty leading up to the election in the US. I think there is slightly more positivism, and maybe a little bit of improvement when it comes to orders that some of the customers plan to place are actually materializing slightly faster than what we have seen. Whether that is significant, I should be cautious on saying that, but I think the general sentiment is probably slightly a bit more positive.
Just to follow up on oil and gas, can we talk a little bit about your exposures? We know from others that have reported that U.S. onshore is coming back nicely, but offshore in general might not return until 2018 at best. I think you are mostly exposed to offshore, so could we see that your oil and gas business might effectively flatline for the next 2 years, or are you simply better exposed given your relationship with Statoil?
Of course, we have a fairly large exposure towards Statoil, but there is some good momentum in, I would say, quite a few regions. Things start to happen in the Middle East. Also on the refinery side, we have brought out new products also to serve a slightly different part of the oil and gas market, or I should say the hydrocarbon market. So the big tickets would probably still, we would need to wait some time to see coming through. But I would still expect to see some improvement coming from smaller developments on oil and gas, while the bigger ones that have been on hold for quite some time, we are still late in their cycle from the EPC side to be sort of awarded and to see that materialized into the larger ticket orders that are coming from them. So yes, I believe that we will see some improvements on the oil and gas side, but the big tickets are yet to come because the larger projects, given where they are in their approval and development cycle, those would still be sort of 2018 numbers to be looked at.
A quick final one on construction. You report better backlog conversion than I thought. Was there any mix with higher premium hoist moving through the backlog, or is the margin improvement just on the better volumes in the quarter?
I think the volume was the bigger part on this one. Of course, we are having a target, our own internal target. When we sort of overshoot on that, you get a high leverage on the overshooting volume, and that of course is giving a nice contribution.
Thank you, Tormod.
Follow-up on the side. You're meeting, or it seems like you are meeting a very tough 2016 with very strong growth in construction. How do you view this entering 17? Is it a very tough comp, or is there still regions, segments that aren't really touched with your rather new mid-market assortment? So can you still be optimistic on construction given the tough comps?
I'm always optimistic, but no, I haven't really seen anything that would fundamentally change my view on the overall market situation. We are still looking at large development projects in the construction industry being, moved forward for execution. I would again say that I'm fairly optimistic in terms of what I see in most markets.
And then on the industrial side, any update on your investments in mid-market assortments for the industrial side and what you're...
No, I think, well, if any update, the only thing I should probably like to mention on that is, I think I mentioned that during the presentation, but we had we have developed what we called an EX elevator for mid-market, and that one was, these solutions are subject to approval by authorized bodies, competent bodies. So our has been approved by TÜV, and we just launched that at the very end of last year. So it is hard to give, I don't have any sales numbers, so I couldn't say whether this is a great success, but we believe that this is a product that is in demand out in certain markets, and I have good hopes also for that one, adding to the continuous progression that we are expected to see in the industrial side.
But have you started to market the product?
We have started to market it, yes.
And how's the reception so far, and how
Oh, it's
long
good.
are lead times? If we relate to the construction side, how long did it take from presenting the product to customers until you actually got the first sales?
I think we have got the first sale, but we've got that. So no, we have sold it, but we have not yet installed it because we're still waiting for the final certificate. But we have sold it.
Okay, thank you.
And it is being good received, well received.
Yeah, so I guess someone has to ask the Trump question, so
Okay.
let that be me. So for the three companies, the old Alimak, Avanti, and Facade Access, how are your... I know that in the old Alimak you don't have any production in the US, but your competitors doesn't either, so it's sort of competition neutral there. But for the other two groups, are there a major difference between your manufacturing in the US versus outside compared to competitors?
Now I can brag about having a manufacturing unit in Franklin in US. So we have manufacturing in US. The group has manufacturing in US. Avanti has a manufacturing unit in US. When you are referring to Trump, this is of course something that we will look at. What we are looking at is, of course, do others have any competitive advantages over us? And as long as we don't see that, we have no plans on, making any investments, because that is also taking time, money, and management time mostly. But we will cautiously review that, and given the sort of capital needs that we have, if we should decide to set up something, we could still be fairly quick up running, if that was a need. So I can only for now say that we are cautiously following what the market is doing, and we will of course react to events in the market.
Thank you.
Do we have any more questions from the audience on the phone?
At this point, we don't have any further questions. Once again, if there are any questions on the phones, please dial 01 on your telephone keypads now.
Then I would only like to finish this presentation with saying thank you to all of those of you who took the time to listen, being here. I'm sure I will see you soon again. And thank you for coming, and have a good day. Thanks a lot.
Thank you.